Hey, what's going on, guys? Welcome back to another episode of Get That Bread. So on this episode, I wanted to do things slightly differently. Instead of talking about another investment idea or a financial metric or anything along those lines, I wanted to bring on a guest and kind of engage in a conversation that's more geared towards the new folks to all this, who never went to business school, who never pursued a career in finance, yet still wanted to dabble. And so hopefully out of this conversation, you could kind of extrapolate a few concepts or ideas that will help you map out how the financial markets or the stock market more specifically works. And so I thought it was kind of a fun conversation. I thought it was kind of interesting. So there's some points that hopefully will be helpful to you guys. So one quick note, unfortunately, my camera kind of sucks. So I didn't really have, I don't really have any video footage of the conversation. It's just purely audio. Really sorry about that. So, but the episode is also recorded and available up on podcast. So if you want to be able to just kind of access the episode from there, that might be something a little bit more convenient for you guys. But I just wanted to have this available for you guys to access on YouTube as well. So without further ado, I don't want to hold you guys up. Let's just kind of dive right into the conversation. I'll see you guys next time. All right. Hey, what's going on, guys? So today we're going to do things a little bit differently. Instead of talking about a specific company or specific investment opportunity in the stock market, we're going to have a conversation around with my guest today, my brother, around investing in the stock market as a retail investor, just kind of investing from your personal account, and some reservations that some folks may have when approaching the stock market, especially if you never pursued a career in the financial industry in the past or anything along those lines. So just a little background on my brother. My brother came out of Emory University's Because Business School. He studied organization management, and today he helps lead a 40-store clothing retail company. And so for quite some time now, he's been in this life stage or in this position to have the means to be able to invest. And I think, and I don't think he's alone in this category here, but I think he's kind of approached the stock market slightly hesitantly, or has had certain reservations about actively investing in the markets, even though they've over time generated, in my view, what's a kind of compelling rate of return. So so we're just going to talk about stocks overall and kind of the mechanics behind what drives valuations up, what drives valuations down, and we're just going to go from there. So, Vic, would you say that's relatively accurate around your suspicions involving the stock market, that you're slightly hesitant to devote time and resources towards investing in the financial markets?
Yeah, I would say that's accurate. I think, as you had mentioned, I do work in business, but in a unrelated, not a directly related field. And so having a full-time job, I think it's difficult to, figure out exactly where to go with the stock markets. And I think you're correct in saying that I do have some suspicions and reservations with regards to trading stocks, just I guess with my cursory knowledge of how everything works. And hopefully you can kind of shed some light and, make some practical suggestions as to, as somebody that doesn't necessarily work directly in finance, has a full-time job, has a little bit left over after paying all the bills. Are there other ways to, grow financially outside of my regular 9 to 5?
For starters, what would you say is kind of your biggest suspicion involving the stock market?
Well, if you want to start with suspicion, I guess, so having somewhat of a background in business school, blah, 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 whatever you want to call it, I kind of understand the gist of how it works. But, sometimes, what they say is it's more dangerous. How does the saying go?
Oh, you don't know what you don't know, something along those lines?
Something like that. So, I know a little bit. I know just enough to be real dangerous. I think that's the saying, something like that.
Well, we've had a lot of conversations in the past, and you've raised a lot of great questions that I don't even think active investors raise themselves. And so I think your knowledge of the stock market actually goes beyond simply quote unquote cursory knowledge. And so for someone who, especially for someone who understands the P&L for a company, understands organization management, I was just a little surprised that that you are as reluctant as you've been to kind of move forward in kind of, considering alternative investment opportunities, especially financial securities.
Right. So yeah, having having experience managing a retail company and looking at the financials, managing a P&L, or basically a profit and loss statement, and all the other associated financial statements that kind of go into telling me the health of our business. I would say that the way I think about a P&L, or the way I analyze a balance sheet or what have you, I think it's more on the perspective of how is our company performing, right? And so the perspective as it relates to those numbers on Main Street versus, I guess, the way Wall Street looks at those numbers, I mean, that's where I think the biggest disconnect is and hesitation, because the way I see it, in retail, on Main Street, whether you're selling clothes, or you're selling cheeseburgers, or you're selling gas, or you're selling a service, you get paid for what you earn, right? So, I buy a widget, or I buy a banana, or I buy a gallon of gas from some supplier. We add value by merchandising it correctly, giving customers access to this particular product, and then we mark up to earn a profit for the value that we add, and then we sell that product at a profit.
But I think the underlying principle, though, between like investing in a stock and say selling a piece of garment, it's quite similar, isn't it? I mean, well, anyways, I guess
I'll tell you why it's different.
Okay.
In my mind, it would be the same, investing in a company and earning money from my investment would kind of be like, I see it being similar in the sense that, like, let's say I was Mark Cuban, right? Or one of those investors on Shark Tank, right? So, I go, let's say I really love this pizza joint in my town. And I know this pizza place could scale because their pizza is amazing, right?
Okay.
And so the owner of this company might come to me, let's say, and he'd be like, "Yo, I need to open up another pizza shop. And in order to do so, I got to buy an oven. I got to, do some upgrades to a space, blah, blah, blah." And he might say, "Hey, can I borrow some money in exchange for this money, this cash? I'm going to give you a percentage of my profits," right? So that, that's kind of how I would feel it should work when you buy into or buy stock in a company where, let's say the guy's name is Sam. Yeah, Sam, let me give you, $100. Here you go. Go buy some dough, buy a little bit more sauce, and mark it up, go sell it to the end consumer and make some profit. And then, we'll split some of the proceeds from that. That's the way I would think investing should work. But, I don't think that's the way it works.
Okay, well, do you have a brokerage account as of today?
I do have a very small brokerage account.
Very quote-unquote small brokerage account. Okay, so what kind of, when you're approaching the stock market, especially as someone who has a career that's outside of the financial markets, when you open up your brokerage account and you decide, hey, I'm thinking about buying this stock or that stock, what are your biggest concerns? Like what's kind of going through your head? What's your methodology?
So with my existing account, I opened it up just kind of for fun.
Okay.
To be honest.
So what's the purpose?
Is
it just like, let me just play around here?
Kind of. It wasn't really a tool a vehicle that I thought would actually be a real earnings vehicle. I just kind of wanted to dabble. I think a lot of people have very small brokerage accounts. I think it's not just me. I mean, just from people that I know. I think it was just a matter of dabbling and trying to have some fun and just trying to figure out how things work. And so I've had some good experiences.
Uh-huh.
I bought Apple very early on, and I think I did what a lot of people do and did, which is they see a company that they personally like, they think it's got growth potential or it's got legs, so they invest in that company. I've also had some very bad experiences using that methodology. Obviously, I didn't put in the full analytic that you finance guys do. And I saw a company. I thought it was admirable. I liked it. I thought a lot of people shopped at this particular store. And in the beginning, I made a lot of money.
Which
Not
particular
a lot of
store?
money. I mean, relatively speaking.
Which
of course.
particular store?
It's a brand that it's a store that it really, really. I don't even want to mention the name of this company because.
It's one of those.
I made a little bit of money in the beginning, and then they eventually went bankrupt. I don't know what that means exactly, because when I go to the mall, I still see those guys operating, and it's like, yo, guys, where the heck is my money? This is what I'm saying. I don't appreciate how this whole thing works, because you know how when we buy stocks, we're essentially buying them on the secondary marketplace, right?
Right.
It's not, yo, I like your store. Let me give you $100. At the end of the year, if you make a little money, send me a check, right? I get a check in the mail. That's not the way it works in the secondary markets. Secondary markets. Did you explain to your listeners what the secondary marketplace is?
Yeah. So see, you raise certain terminology that kind of points and highlights to the fact that you don't have a cursory kind of base of knowledge. So I think, which is a good thing, because then, regarding the secondary market, there's the primary markets, and then there's the secondary markets, which my brother Victor's alluding to. The primary market is simply where the company, when they first issue their shares, they're issuing it to the first investors that are actually going to own shares in the company when a company goes and conducts an initial public offering. That's the primary market. And now when those shares start changing hands again to some other class of investors, some grouping or some other investors, now you've entered into the secondary market, because that money is no longer going directly to the company, but it's being exchanged between investors. So that's kind of how to think about the primary market versus the secondary market.
Yeah.
But
so to me, let's go back to that illustration, right? Let's say there's this pizza place. I love pizza, so I'm going to keep using this pizza illustration.
Okay.
But let's say one of our buddies, let's say his name is, what did we say his name was?
Sam.
Oh, Sam.
Yeah.
Okay, so let's say Sam's got this pizza store, and he's got one store, right? And this pizza place is awesome. It's the best place around. And this guy, Sam, he knows, and Sam and I know, that if we were to invest a little bit of cash, because obviously if he wants to open a second store, he's going to need cash. He's going to need cash for a new oven, more dough, more sauce, and more cheese, right? So
initial capital to make the business up and running.
Yeah, he's got to right. He needs a little bit. He needs more cash than he's got to be able to go make that significant investment to open up a second location. So that's why, in order to raise that cash, he can go get a loan from a bank. Or he can decide to get investors, right, that will give him cash in exchange for a share of future profits of that second store, right? Mm-hmm. So in that case, I would be the initial public offering or whatever it is would be Sam being like, hey, Vic, I want to open this second store. Can you give me some money? If you give me this money, I'll share the profits of this second store with you and the first store, whatever it is. So I'd be like, okay, your pizza's fantastic, and I want to do it. I'll do it. And at the end of the year, you take all your sales and you minus out all your expenses and all your taxes and blah blah blah. And then if you're left with some profit, then let's share that profit, right? Whatever. With 50-50, 60-40, 70-30, whatever it is,
right.
80-20,
proportionate to what you invested versus what Sam invested,
right? And how much Sam puts in work versus how much I put in work, right? So taking all that into account, we'd come up with some fair arrangement because we're buds, and we would get a little bit of money and he'd get a little bit more money because he's operating. But anyway, long story short is that's the way I think investments should work. But when we talk about secondary, so let's just say, let's bring up a company, right? Let's say, what's a hot up and coming, what's an IPO that's going to launch this year?
Uber. Uber.
Who?
Uber.
Uber.
Yeah.
So Uber, for example, let's say, so they're what are they right now? Are they a private company or what are they?
They're a privately held company.
They're a privately held company, owned by
Some conglomerate, some syndicate of investors, some group, some mix
group,
of
right. So it's not like
investors.
Sam who's opening up his
Right.
shop, right?
Right.
So already there's people. So they're basically a bunch of people before they've decided to launch as a public company.
Okay.
A bunch of organizations, institutions, rich people, right? Put money into this company already, right? To kind of bolster, give you Uber the funds so that all these sketchy people can drive around and whatever, right? But anyway, so there's all these people already with their hands in the pot, right?
Okay.
And now it's like, okay, guys, we want to raise even more money. Okay. So we're gonna go public, quote unquote, go public, right? And issue this initial public, what is it?
offering.
IPO. So then they go to regular people out there and be like, yo, can you guys give us some more cash, right?
So I think
here's the thing.
I think you're touching on a lot of your suspicions though revolve around some of the mechanics involved in companies launching publicly, and then also how there's a disconnect between publicly traded companies versus privately held companies.
Well, I guess
like
what it is
mom and pops, right? And so because of that disconnect, you have a high level of suspicion around owning the companies because you don't think you're actually owning the businesses.
Right. I don't think I'm owning anything.
You don't think you're owning the businesses.
I don't think so. I know technically I'm owning something. I'm owning a piece of paper that says I own a share of Apple.
It sounds like it's just paper ownership.
It sounds like I'm owning paper, and for me to invest money, my money, my cash that I've worked hard to get, and to buy these pieces of paper, it doesn't. I guess I have a reservation, and it's not. I guess it is a suspicion on some level, but I think it's more like, I don't want to. I don't have the time to put in all this effort to put in all this, the analytical groundwork to make these investments, right? And
that's fair.
Furthermore,
I think most people are like that.
And furthermore, I don't. I don't know exactly what I'm getting. Let's say if I'm putting in an order of jeans
from like some factory in China,
right, I know what I'm getting, right? I'm getting something,
right?
If I'm buying a stock, I don't know what I'm getting. I'm just getting a piece of paper.
That's what it seems. That's what it feels like. I think part of
it because I've owned, like I said, I'm not getting a check. Okay, that company earned a profit. Okay, I'm not seeing any part of that profit.
How about we just touch on that right there really quickly before we move on to the next subject. So when a company actually generates, let's say, $100 in profit in a publicly traded company, that is, you have hired a management team. Maybe not necessarily you, but there's a board of directors who represent shareholder interests who hire the management team, and that management team decides what to do with that $100 in profit at the end of the year. Now, I don't know about most cases, but in many cases, that management team believes by reinvesting that $100 back into the business that next year, instead of $100, there'll be $105 or say $110. And so instead of, say, issuing, Victor a check for his proportionate interest in that $100, management believes that by reinvesting most of it back into the business or all of it back into the business, investor, why don't you just wait a little bit because there'll be more profits along the way that could be distributable at a later point in time. But at the same time, that's one grouping of companies. But there's another grouping of companies where some portion of profits are in fact paid back to investors. And so it really depends on the kind of company that you're looking at.
Right, and those are called dividends, right?
Exactly, dividends.
Right. Okay, so it sounds great in theory. So you got to understand this, right? So and I know you do, but basically, my one share, let's just say, or my 10 shares, or my 100 shares.
Okay.
Let's say I have $1,000, invested in Apple. Let's say I have $100,000 invested in Apple.
Okay.
Let's say I have $1 million invested in Apple.
Okay.
Let's say I have $10 million invested in Apple, right?
You still won't be able to dictate what
My
management does.
$10 million
Right.
that I have invested in Apple means jack squat, right? Compared to the larger pool of investments that are going into that company.
Right.
As a retail investor,
But don't you think that's fair?
as a retail investor, my money
Uh-huh.
and thus my clout,
Uh-huh.
my influence or whatever
Right.
it is, whatever it may, I don't have any say in anything.
Okay.
Right?
But let's go
Not
back
that
to
I
your,
have a right to have
let's go
any-
back to your illustration on Sam's Pizza Shop though. Whether you're Joe Schmo or Gordon Gekko, everybody who invests in the stock market, meaning everybody who wants to buy ownership or equity in a business, they want to make money, right? They want the value of their investment to increase. So it's not like some investor or some like Gordon Gekko out there, he's going to come in and make life for the small investor really miserable. Their incentives are totally aligned. They're the same thing.
Right. And okay, but I guess just emotionally speaking, the way I kind of feel about the stock market, especially for retail investors, is that it's kind of feels like a pyramid scheme.
A pyramid scheme.
Yeah, in the sense that if you're, let's say, the whole thing with PE ratios, right?
Okay.
So let's say a certain stock is priced 10 times more than this thing is earning,
Okay.
right?
Okay.
And I'm coming in now, right? The
Okay.
stock's been around for a long time, and I'm coming in now.
So let's say like
Okay.
a 10 times PE stock.
Yeah.
Okay.
So I feel like, there's a lot of like I don't get how some of these multiples justify themselves.
Right. As
You know what
as do the best investors on the planet. Sometimes they just don't think. So take for example Uber. Did you know that Uber every single year they lose in operating margin, actually even above operating margin. But let's just hypothetically say it's called operating margin. They lose over $1 billion a year.
Okay, exactly. So
Isn't that insane?
So this entity.
But that's
so
why
this company-
that's where exuberance comes in. That's where if you kind of rewind back the clock, 1998, 1999, which is when the tech bubble I think burst. A lot of those companies, they were exactly like
So
how you
this company-
exactly what
so
you
Uber-
characterized. They're
Uber-
just paper. They're just paper. It's
Uber loses how much a year?
over $1 billion a year, and
So
they
this
think
company
their
is-
valuation is closer to $100 billion, $90 to $100 billion when they IPO. I think later this year.
The valuation of the company is So this is what I'm trying to say is I don't get these astronomical multiples that exist.
Neither, you know what? But I think you're in good company because neither does a guy like Warren Buffett.
But not even just like, okay, so there's those
So that's why he owns companies
there
like
are those
Coca-Cola.
absurd ratios that are out there like that, right? But
Yeah.
then I also don't understand even ratios of like, for established companies, where they're trading like 5, 10 times earnings. I just don't get why I would pay 10
So
times
what?
more
Think about it
than
this way.
what this company earns on an annual basis. Why would I pay 10 times what these guys are making in a profit, for my share, right? Of what my share can possibly earn.
Okay.
So let's say, Coca-Cola, let's just say, what's the multiple on Coca-Cola right now?
I don't know exactly, but let's just stick to that 10 times number you're talking
Okay,
about.
let's say
Why would I?
Coca-Cola.
Why would
Let's
I?
just say Coca-Cola's 10 times. Let's just say it is.
Okay.
Right?
So, but let me ask you another question.
Without checking the Yahoo Finance.
Let me ask you a question though. Would you own a 10% yielding bond?
Would I own a 10% yielding bond?
Yeah, that comes due in say 10 years. And
So,
let's say
let's analyze that. Let's say
Okay.
So let's say that let's say I got $1,000.
okay.
Okay. Let's say I put aside $1,000 after all the expenses this month. I got an extra $10,000. Sorry, $1,000. So what would that 1,000? If I get this bond, and I spend $1,000 on this bond, what would I get next
You get
year?
at the end. So let's say you bought it January 1st, right? that means at the end of the year you would get $100 in interest payment.
So I'd get $100.
$100.
Right? Okay, but my 1,000 is still with the
company.
with the bond, whatever. Whoever's owning it.
You
bond.
own the bond, and you get $100 at the end of the year because it's a 10% coupon, 10% interest you're getting.
Okay.
So my question was, is that compelling? Would you own that?
Yeah, I think so.
Yeah, but I think a lot of people would, assuming that you're going to get 10% year in and year out.
Yeah.
Right. But that's.
And at the end of the life cycle, at the end of the 10 years,
you get your money back.
I got to get your money back. 10,000, my 1,000 back. My principal.
Exactly.
So then at the end of 10 years, how much would I have in my pocket?
Well, $2,000, not including inflation,
compounding the interest also, right?
Well, assuming that you just pocketed the interest and you didn't reinvest it, you would have $2,000 gross. So not including inflation, not including the loss in value or whatnot. But at the end of 10 years, you would have $2,000 because you'd be paid back your $1,000, your principal, and then you would be paid $100 every year over the next 10 years. So you'd have $2,000.
So yeah, I mean I guess that sounds pretty good.
Yeah, but I think that's.
So how does that equate to me buying a share of Coca-Cola, paying 10 times more now?
So when you look at the PE ratio, right?
Oh, I see where you're going with this.
Yeah, I'm going to earnings.
Finance.
I'm going to earnings yield.
I see where you're going with this.
I'm going to earnings yield.
Shady.
No, I'm not going to.
So you're assuming that, okay, fine. If this thing is earning $1 for the $10 I'm putting in right now,
let's say it's $10
I should be
per
getting
share.
A check at the end of the year for at least $1.
Exactly.
But
you have.
Right. as I don't see. I've owned stocks long enough, and I've lost enough money to know that Coca-Cola ain't sending me no check for $1 at the end of the year. It's not happening
Because Coca-Cola is management team. So you have to. So you as an
let's
investor.
Let's go ahead and let's go back to that $1,000. Where I think $1,000, for discretionary.
Wait. So let me clarify.
For like a normal guy.
Let me clarify that. Let me clarify. Let me clarify that because most people aren't going to get.
So let's just.
Most people aren't going to get what you just arrived at.
Oh
so
my gosh!
I'm analogizing.
Am I listening to a snake oil? Am I a salesman here? You sound like You sound like a used car salesman over here.
No.
You tell me this: if I buy that stock, okay, let's say I buy $1,000 worth of Coca-Cola stock.
Let me clarify first why I asked you the question.
Your customer is speaking here. Guys, this is why I have this suspicion about investing in stocks. Okay, let's listen to this finance guy explain this. It's not
finance. It's finance. Okay, I hate it when people say finance.
If I spend $1,000 and I buy Coca-Cola stock today,
okay,
at the end of the year, am I going to get $100?
No, you're not.
Okay,
so here's the difference.
Fine.
Here's the difference, though.
Let's just go on with that illustration. And after end of the year 2, am I going to get a check for $100?
No, you're not.
No, but they earned $100. Let's just say, right? If I versus my $1,000 I invested, Coca-Cola earned $100. The company, right?
Yeah.
All right. But I'm not seeing a check in year 1. I'm not going to see a check in year 2. Am I going to see a check in year 10 if this company does not issue any dividends?
No.
I ain't going to see no checks.
You're not going to see any checks.
What happened to
no
my
cash in your pocket? So when it comes down to the company that you're taking a look at, you have to decide, okay, is this a dividend issuing company or is this not a dividend issuing company?
Right.
And the reason
stocks that I've owned over the past, 5-10 years and dabbling in the stock market, 15 years, I've owned like Apple, I've ownned Facebook. I still own Facebook. I still own Apple. I own.
It's quite convenient for you to name all your winners.
What else do I own? I own
which
Google.
one was the loser again?
I own Google. Like I own half a share of Google.
Which one was that bankrupt company?
I own. What else do I own? I wish I owned Home Depot. But I wish I.
Okay,
got it
let me start answering your question though.
Quick shout out to Home Depot. Okay, I love that store. Why?
All right, but I have to answer your question.
Time out Wall Street. Let's talk a little bit about Main Street.
Okay, I've been on Main Street for quite some time now.
Street.
I've been on Main Street.
Home Depot, every time I go into one of those Home Depots, it doesn't matter where I've been in a lot of Home Depots in the business that I'm in. Okay.
They're a great business.
Every single
they take
Home
care
Depot
of
that I go in, their employees, okay? I could go from the
That's a great company.
I could walk
That's
from
right.
the
It's a great
light bulb
company.
section of the store and I have a question of, let's say, something I need in the lumber part of the store, which is like on the opposite side of the store oftentimes.
I don't know why
They're
your
all
Jersey accent
knowledgeable.
just got thicker.
They're really knowledgeable employees, and they're helpful employees.
Okay, so let me circle back to the reason why I raised the question initially, as far
Let's
as
get
why
back
would
to
you?
why am
because
I
I'm
not
trying to,
getting a check?
Yeah, so I'm going to touch on that. I'm going to touch on that briefly. But for the listeners who aren't really catching on to why I had raised that question to begin with, is because if you're getting a 10% yielding coupon bond that's going to mature, or meaning you're going to be paid back the full principal amount within 10 years, it's the same question of whether or not I want to buy a 10 times price to earnings stock. Because if you were to invert the price to earnings multiple ratio, it's an earnings yield which is comparable to the interest rate calculation on a bond. So the difference between debt and equity, or part of the difference between debt and equity, is that your equity value could increase substantially due to the growing earnings power of a particular business. And so the reason why you're not getting your check back at the end of year 1 or year 2 or year 3, and maybe not ever, is largely because the management team in which you had indirectly hired through the board of directors has decided, if we reinvest this money, this $1 per share in profit this year back into the business, we believe our management team can generate more earnings per share next year for our investors. So it should be more than, so instead of $1 this year, next year we're going to make $1.20. So if the company still trades at 10 times PE in year 2, well, the value of your stock just went from $10 to $12, which is a 20% unrealized capital gain. That sounds very enticing, doesn't it? That's the reason why you're not necessarily going to get cash back into your pocket.
Right, but here's what I don't understand, right? So basically, cutting out all that finance speak, what you're saying is my $10 that I bought in Coca-Cola, right, to buy $1 in the profit that Coca-Cola made, right?
Right. You had paid $10 in exchange for
$1
in
their
profit.
Right? And my $10 is going to be locked into that company until I ever decide to sell. Right.
Right.
And every year I'm going to make $1, assuming that the company makes $1. What you're saying is next year, if Coca-Cola, let's say, made $2, right?
You have a $20 stock right there.
You think you have a $20
if
stock.
multiples, the price to earnings ratio remains at 10 times.
Right. If the price to earnings ratio remains 10 times.
Right.
So does that happen?
A company doubling their earnings?
Yeah.
Yeah. It's happened in the past. So I'll give you an example of a scenario where that has happened or was anticipated to happen, and partly did become realized. I think back in 2012 or 11, somewhere during that. No, I think a little later than that. 2013, 14, somewhere in that time frame. I was looking at a coal company called Hallador Energy, ticker symbol HNRG. They're kind of this sleepy company that historically generated like 80 cents in earnings per share for like a decade. Now, nobody was really paying attention to it.
It was earning 80 cents a share.
80 cents a share, and it was trading at 10 times PE, roughly about 10 times PE. But because it was such a sleepy company, because it hadn't done that much, not many people were really paying attention to this particular name. And then on top of that, coal structurally as an industry is shrinking in a really meaningful way. But here's the interesting thing. The management team got a hold of new mines that were anticipated to effectively double earnings. And they did it without diluting shareholder interests. So they didn't issue new shares. They just took out financing from a bank to buy more mines. And when they did that, they guided or told the investment community, hey, this is how much money we anticipate making. On a per share basis, when I backed into the math, they were gonna increase their earnings per share from 80 cents per share to approximately $1.60. So, assuming that the PE ratio stays the same, you would have essentially doubled the value of your
So
investment.
assuming, right?
Yeah,
But did
right.
that
So
pri-
there's
did
a lot
the
of moving
price-
parts. There's a lot of moving parts
So
to this.
did the increase in earnings, did it eventually get, baked into that price?
So what had happened?
Of the
So it was
stock.
trading at about. I'm going off of memory here, and it's been a few years, but it was trading at about $8 a share. I think after a few months after the announcement that they were going to purchase their mines and whatnot, their stock price went from $8 a share to, I believe, $12 to $14 a share. And I was anticipating that it was actually worth closer to $16 to $20 a share. Unfortunately, so again, in the financial markets, there's a lot of moving parts. Precisely at that time, OPEC, which is a cartel in the Middle East, decided we're going to slash oil prices and we're going to jack up production in oil.
So basically, something bad happened.
Well, I need to explain. I feel like it's important to explain how.
Hey, finance. Don't
I need
get,
to
don't
explain
get angry
how.
Here. Don't get angry here.
No,
Calm
no,
down.
no. I have
We're just
to.
trying to sell some pizzas, all right?
I have to explain how intricate the financial markets really, in fact, are, and how there's so many moving parts, so and why there's no guarantee, even if you anticipate a doubling of earnings. So OPEC, they had jacked up production because natural gas in the United States, the level of production of natural gas in the United States was booming. Low interest rates were financing an entirely new industry called fracking, which is long story short.
I think you're bringing up a great. I think you brought up a great.
Long story short.
Long story short. This is illustrative of something that's kind of makes me my head spin a little bit when it comes to stocks. Okay, all right. So I know pizza, right? I know when I go into this store. Okay, this pizza shop, and I taste that slice. I know what makes a great pizza.
Okay.
And I know what the price of that pizza should be.
Okay.
And I can analyze.
You're
the heck
insinuating
out of
that pizza, owning a pizza shop, is far more stable.
No, what I'm saying
far more
is that
stable as an investment.
I know the business.
Okay.
I don't know the business, but I know pizza. At least I know something about that business.
Okay.
And then I'll go in there, and as an investor, yeah, okay, the pizza tastes great, right? But this whole thing with Tupac, what did you say about this whole Tupac or something?
Tupac?
I don't know. You had mentioned a bad guy that affected the oil industry or something.
Tupac? OPEC.
Okay, whatever.
OPEC. OPEC.
OPEC.
OPEC, which is a cartel.
A cartel. That sounds dangerous.
Uh-huh.
But, I don't know anything about all that kind of stuff. You get what I'm saying to you?
Okay.
So
that's fair.
To plop some money down, to me, it's like, I'm placing a bet on something I really don't have an understanding of.
Okay.
Now, as a retail investor, I did try to invest something that in a company that I thought I knew a little something about.
Okay.
Okay. So, like you said, my background's in apparel.
Right.
Right. So, the company that I invested in, Aeropostale. Aeropostale, Aeropostale, whatever that. I don't know. Aeropostale, whatever that company.
Aeropostale. I don't even think I know how to pronounce it entirely.
Maybe that's
correctly.
the problem. That company, whatever did what it did, but I saw that, every time I went to any one of these malls that we operate in, that Aeropostale was extremely busy.
Okay.
Right.
Okay.
They had great jeans.
Okay.
Great tops.
Okay.
Their price point was excellent. There were long lines at the register. So, I'm like, I think that company's doing pretty well. I'm going to buy some shares there. Mm-hmm. Right?
Mm-hmm.
I did check the PE, and the PE at the time was comparable to a lot of its competitors, because I figure, okay, so if, let's say, Abercrombie and Fitch,
mm-hmm.
or what are some of those other little preppy brands?
American Eagle.
Hollister,
Eagle. Which I think is the same thing
Hollister's
as
owned by
and Fitch.
Abercrombie. But anyway, all those companies were all basically trading within the same range as it came to P ratio.
Uh-huh.
And to me, in my eyes, and obviously I should have done more of full analytic. But Aero was the busiest during that period. And yeah, I made a little bit of money when that happened.
Uh-huh.
And then for whatever reason. I mean, I know I know how brick and mortar has been performing over the last 10 years. The whole landscape's changed. Kids have changed. People have changed. Shopping habits changed.
Right.
All that.
Right.
But at some point, that company essentially, I think it was trading at $14 a share or something.
Okay.
Somewhere around those.
Okay. And then
unfortunately, it got down to like 75 cents a share. And I'm like, and I went around to these malls, right? And I'm not actively going to these malls to look at Aero Pistol, whatever it is. But those stores were still operating, and they were had inventory. Their items were priced right. There were still, customers at the register, not as many as they were 10, 15 years ago. Whatever, right? So I'm like 75 cents a share, right? Compared to what I was paying earlier for this company 5 years ago, $14 a share.
Yeah.
Right?
Yep.
So I'm thinking 75 cents a share, hey, that's a good deal. Okay? I think most people would be like, yo, something that I was paying $14 for 5 years ago versus 75 cents now. Yeah, 75 cents, that sounds like a pretty good deal. Right? So I bought a bunch of stock at 75 cents a share.
Yeah. Let me ask you a question. Okay. Did you read up anything on what had happened in the news or in their investor relations page?
I mean, what am I going to do as a retail investor? I'm going to read the one quick and easy thing that I can look at, right? Okay. Which is like Yahoo Finance. Okay. Or I might look at CNBC or something like that, right? Okay. So I'm like, okay. At the time, I remember they were talking about there was not a lot of concrete what was going on, right? Okay. It was just the typical noise of the traffic is down, inventory's up, blah blah blah. Okay.
I want to just quickly interject really quickly.
Long story short, that company declared. I think they declared bankruptcy. I'm not sure. I just know that one time I logged into my TD Ameritrade account, right? and it was down to like pennies, and it was delisted. It went to a price where that stock was delisted from the exchange, which I guess it meant I couldn't trade it anymore. Okay. Right. I still own the number of shares, but it was so cheap that I couldn't trade it to anybody. Okay. Right. I'm like, okay, what the heck is going on? Oh my god, what the hell is going on? Right. Okay. And then I find out, okay, so maybe they're going out of business. Okay. Maybe this company's going out of business. Right. So it's understandable.
But their doors are still open.
It's understandable. Yeah. Okay. Now it's 2019. I don't know. It's been like
we're like 5 years. 5 years removed from that event.
5 years, right? Okay. And I go to the mall, and who do I see operating?
Aeropostale. Yeah. Okay? So yeah,
they got the registers ringing. They got the inventory. They got the stores, and I want to know, where is my money? Where's my money? Okay.
You brought up a lot of things, and let me get to that. I'm going to ultimately circle to your point your question about where's my money. First of all, I think you're right. As a retail investor who, if you don't have the time or the resources to do some digging on your own, it is a very dangerous thing to do.
Before you move on, let me just put a disclaimer in there. Okay. I do understand that when you make investments, right, in any kind of business, you don't. There's a measure of risk, and I'm not saying that I'm entitled to any money just because I've invested in it. But if that store is still open and still operating is what I'm saying. Like, I feel like
you should be entitled to something.
I should at least have the opportunity to have my stock relisted so that I could do something with it instead of being completely delisted. I'm like, okay, I'm stuck in no man's land, especially if that store's still open. It's not what I'm saying. I'm not saying that there's no risk in business. Right. Business is risk. Everybody knows that.
Like we said, I think we're 5 years removed or something along those lines from those events happening. And so I don't remember all of the details. But when a lot of things coalesced together cumulatively to create such a terrible retail environment, and you know it better than I do. The point is that the whole retail landscape changed. The 2000s were a totally different retail landscape versus this most recent the decade that we're in right now. And so when Aeropostale, their financials started looking much weaker and weaker, largely due to the fact that mall retailers started discounting at such meaningful rates. That's why for some of you older people out there, Abercrombie and Fitch used to sell jeans that were at least $80 and higher. I don't think they do that anymore, largely because they just don't have that pricing power as they do today. Those kinds of things negatively had impacted Aeropostale, and I'm not sure if Aeropostale took on debt to finance its operations in this most recent decade. And if it had done so, if they weren't able to service or pay for their debt or the interest on their debt, that means the company is sliding into bankruptcy.
Which is happening with a lot of companies.
And so
this year, last year, a lot of stores that we used to shop at, it's happening to a lot of those, and that's part of the equation. That,
but speaking to your question though, why is Aeropostal's doors still open and I haven't received anything back? Is largely probably due to the fact that some other grouping of investors came in, bought out the debt that Aeropostale owed, and now is effectively the new owner of the business. And so therefore, unfortunately, the previous equity owners, the previous owners in Aeropostale got wiped out.
If I'm going to go and invest in something, I better know that debt situation, right?
Yeah.
Like a lot of clothing companies this year and last year, they went bankrupt. A lot of brands that were near and dear to my heart, not just in clothing, but in stores. Case in point, what's the best store of all time that just went bankrupt?
Retail store?
What's one of the
I think one of the biggest shocking
best retail stores of all time, stores that most people loved
probably 10 years ago, J. Crew.
Nope. I don't want to grow up.
Gap?
I'm a Toys.
Oh, Toys R Us?
What were you neglected as a child?
Toys R Us?
Toys R Us. What a great company. What a great store, right?
Yeah. Well, it was a great store.
It was a great store. Lots of factors changed. Shopping behavior, blah, blah, blah. But a lot of that, what happened to Toys R Us, had to do with debt on their books, right?
Yeah. So that's why you have to, especially if you're a retail investor.
And who owns a lot of that debt?
Banks.
And who owns a lot of these stocks in these companies?
Which companies?
In a lot of these publicly traded companies.
Both institutional investors and retail investors.
Banks.
Well, kind of indirectly, I would say. Yeah, indirectly.
Okay. Or a lot of the debt is private equity. What do they call them? Private equity what?
Funds.
These private equity funds that invest a lot of this money in these stocks. They also own a tremendous amount of all this retail debt, right? A lot of the debt. I feel like there's so many steps away from what I understand as a Main Street business person to the whole Wall Street business, right? That it just doesn't make sense that these things would occur. But because of Wall Street kung fu, right? These good-looking, good companies can one day be here and be gone tomorrow.
Well, it looks from anecdotally from an outsider.
It's got to be anecdotal.
From a shopper.
It's got to be anecdotal. Why? Because I'm a retail investor and I've got a 9 to 6 job, 9 to 7 job, right?
Right.
So, but I think what I would love to learn is, not being able to spend the time to go ahead and look through every one of these financial statements, disclosures, right? All this paperwork, yada yada yada. Where a lot of the numbers are probably cooked. You might disagree with me. There's GAAP, whatever, accounting principles, and dot 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 dot. Given that environment, right? For me to take my extra $10,000 a year or whatever it is, like say $1,000 a month. That I have left over after paying everything, I don't necessarily feel very comfortable about logging into my TD Ameritrade account or whatever account and spending that money. But I would love to have another revenue stream because, money is an asset that should make money. That's how it works, right? If you put money into underneath your bed, it's not doing anything.
It's not gonna right. So probably that's a good segue into and how we have to kind of close
Part
this.
2.
Close this conversation off is I think active investing is not meant for everybody, and just because you don't take that path doesn't mean it can mean it doesn't mean anything. It's not a lesser path. It's actually. The other path might be even a more advantageous and a more prudent path, which is to passively invest by owning whole baskets of stocks. So if you had owned the S&P 500, which is a grouping of 500 of the largest publicly traded United States company stocks, or the most reputable ones, you would have done 10% year in and year out. So probably owning that basket and just kind of looking away and not being afraid of what happens year to year.
And I'm sure we'll get into more detail about what that 10% year over year means in the next
episode. Yeah.
But yeah, I mean, if that's the case, then yeah, that sounds like a great opportunity. But I do know that I would love, like I said, I would love to have something outside of my job as a vehicle for
passive income stream
for
kind
earning. For instead of spending, if I could take that, $100 and instead of downloading a few Xbox games, and if that 100 can become, 10 Xbox games later on, or just as an example. But basically, if I could have a real, another real income stream, then that I'm confident about, and that I like to do, then yeah, I would definitely like to learn more about how to get that done.
All right. Well, I guess we'll try to figure that out and discuss that in later episodes. So with that, I think we're going to have to conclude this conversation. And thanks for tuning in. We have similar content available on our YouTube channel called Get That Bread Value Investing. So definitely check us out there as well. And this is also on our podcast called Get That Bread Value Investing. So if you thought this episode was interesting or you learned something new, we'd really appreciate it if you hit the subscribe button, give us 5-star reviews, or give some feedback, and I'd really appreciate it. All right, guys, I'll talk to you guys later. All right, later.